I'm Steve McMenamin. I'm the Executive Director of the Greenwich Roundtable. I'd like to welcome you to our first gathering of the Founders Council for 2005. As you may know, these evening sessions are more social in nature, and we typically examine issues of process and ethics. However, tonight's an exception, as we examine one of the most important aspects of wealth creation, adding value beyond capital. For those of you who may be joining us for the first time, the Greenwich Roundtable is dedicated to understanding alternative investment managers. We define alternatives as the search for inefficient pricing, for uncovering anomalies, and for managers who can influence the outcome of the investment. Tonight we'll hear from two legendary practitioners who'll define their own unique way to add value beyond capital. I'll briefly introduce them. Harvey Miller is the Vice Chairman of Greenhill Company, one of the most respected investment banking boutiques in the country. Before Greenhill, Mr. Miller was a senior partner in Weil Gottshal, where for over 25 years he ran that firm's practice of reorganizing distressed businesses, some of which include Texaco, Continental Airlines, Braniff Airways, Bethlehem Steel, and R.H. Macy. Harvey actively lectures in some of our country's most prestigious law schools. He's also a prolific writer in the field of bankruptcy, workouts, restructuring, shareholder rights, and corporate governance. Sitting next to Harvey, as you might recognize, Carl Icahn is the chairman of Icahn & Company, a broker-dealer and chairman of Starfire Holding Company, a private holding company. Mr. Icahn is also the chairman of American Property Investors, Exo Communications, and the former chairman of Transworld Airlines. Carl is one of the masters in the art of activist investing, a strategy designed to influence the outcome beyond passively watching the stock ticker. Mr. Icahn has brought activist investing to its current state of the art. Carl is also an active philanthropist doing God's work with significant contributions towards fighting poverty, child abuse, domestic violence, as well as important advances in education and scientific discovery. The moderator this evening of the Founders Council is Douglas Makepeace. Douglas, serving on our advisory council and our programming committee, Douglas is one of the insiders of the Greenwich Roundtable. His Sperry Fund Management has been investing in seasoned hedge funds and CTAs for over 17 years. Please welcome Douglas as he sets the table for us this evening. Douglas?
Thank you, Steve. Thank you all for coming. It's certainly a privilege to sponsor and moderate a panel at the Greenwich Roundtable. And I thought I would start by telling you how the idea came up. Back about 25 years ago, there was an interview in Barron's with a hedge fund manager named Oscar Schaefer. And he had bought Haynes at 6 times earnings and then shopped it around and sold it for a much higher multiple. And I thought, well, that makes a lot of sense. I mean, no one buys a business and then waits for someone to come along and pay a higher price. Buy and hope, I call it. They do something. They look at the management, they look at the marketing, they look at the finances, they try and find a buyer or whatever. So I've followed activist managers for probably 25 years now, and certainly one of the most flamboyant has been Carl Icahn. So I thought it would be interesting to have him as a speaker to our members, and I was happy that the Greenwich Roundtable was able to get him as a speaker, and very happy that Harvey Miller could join us. They both have very long experience, and they have very different perspectives coming from different, along completely different career paths. So we'll start with Carl. He'll speak for 15 minutes, then Harvey 15 minutes, and then we'll have a dialogue, and then I'll ask a couple of questions, and we hope to have some interesting questions from the audience. Oh, beg your pardon. All right.
Well, I don't know if I'll accept that.
All right. Well, Harvey, we all want to hear how you went from being a lawyer at a small law firm to a lawyer at a big law firm, and now you can tell us what you do and how you do it, please. how you help companies to unlock value, and what you've learned from your perspectives as a lawyer watching the other participants.
Okay, thank you. I got a little nervous when Stephen introduced Carl and myself tonight, because he said usually the group focuses on ethical conduct, and this would be an exception. I hope you didn't mean that, Steve. I'm not speaking for Carl. My perspective is somewhat different than Carl's, although we have met on a number of different occasions. Having started in a bankruptcy restructuring business some 40-odd years ago. And in 1983, I was speaking to a session at the Harvard Business School, and I was talking about the fact that bankruptcy, Chapter 11, and restructuring had become a strategic tool for corporations. And that looking around in the business world, where people like Carl were getting started, and Irwin Jacobs, and what's his name, Lord Goldsmith?
Yeah, Jim Goldsmith.
Jim Goldsmith were getting started. What were they looking for? They were looking for undervalued companies, where the assets, the market simply wasn't viewing the company in light of the value of the assets. And I said to this group at the Harvard Business School that if you start looking in the bankruptcy arena, in the Chapter 11 arena, you're going to find a lot of companies that are going through reorganization that are not being valued properly in terms of what their ultimate value could be if properly managed. And it was a different world back in 1983 because we had a situation where you had relationship banking. Most of the creditors were trade creditors, and they had relationships with the company, and they wanted the company to survive, and so they would have a customer. And since 1983 and into the 90s, we've had a what I would call almost a revolution in what has gone on, because relationship banking has ended. Banks are almost commanded to become liquid. They mark to market. So the concept of staying with the debtor, it no longer exists. Trade creditors are disappearing, because if you produce anything, if you're selling soft goods, most of it is produced outside the United States. And nobody will cut cloth or manufacture unless they have a letter of credit. So you don't have trade creditors really anymore, except in exceptional cases. So who are the creditors now in the cases that are coming by? Well, they're primarily bank creditors and bondholders. And the biggest change in reorganization in the bankruptcy field and in restructuring is the appearance of the distressed debt trader. And it's interesting that 82% of the traded distressed debt is by hedge funds. And it's a very active market, and they changed the bankruptcy rules to provide for extreme liquidity. There was a point in time when the bankruptcy court had to approve a transfer of a claim. That rule was changed, and the volume with which trading goes on now is almost remarkable. You could sit down with the creditors committee tonight, and I can make a deal with the creditors committee tonight, and tomorrow every member of that committee will sell its claim, and I'll come back tomorrow afternoon and I'll have a whole new creditors committee, and that will change the dynamic. But what has happened is people have begun to realize that there is real value in trading in companies that are in Chapter 11 or about to go in Chapter 11. And Carl is one of the originators of that concept. And I'll give you some examples. I'll tell you about my evolution into investment banking, but I have a limited amount of time, so let me tell you some of the things that have happened in Chapter 11 in investing. Regal Entertainment Group was a motion picture exhibition company put together by two private equity firms, Hicks Muse and KKR. They each put in $500 million in cash. There was a downturn in the industry. The industry had overexpanded. The concept is if you didn't have a theater that had stadium seating, you were really not part of it. So every company with access to capital went out and started building stadium seating. What they didn't recognize is when they built the stadium seating theater 5 miles from a flat theater, people naturally went to the stadium theater. So there was a downturn. There was an overexpansion. There were too many screens. There was a liquidity problem at Regal. The bank debt was $1 billion secured. The subordinated debt was $800 million, in principal amount, and there were lease obligations and some accounts payable of about $195. A man by the name of Phil Anschutz decided, hey, this looks like a very interesting area, and besides which, I don't like the films they're making in Hollywood. So if I can get control of the exhibition business, I'll stop them from making these smutty films. So he started and he acquired a small chain in Los Angeles, and then he went after Regal. And he started buying the bank debt in Regal, and he started to propose that he would swap the debt for equity. He appears, we're not quite certain, that he invested about $350 million to purchase the debt, and the discount was over 50%. The Chapter 11 case was filed in September 2001. The company came out of Chapter 11 in July 2002. He ended up owning 73.7 million shares. In August of 2003, Regal declared a special dividend of $5.05 a share. He received approximately $363 million. In April of 2004, another special dividend was called for $5 a share. So Mr. Anschutz ended up with about $700 million in dividends, and his stock was valued after these dividends at $1.7 million. So he got a 7 times return on his investment. That's one example. Then there is a gentleman by the name of Wilbur Ross, who's a good friend of Carl's. They both make coffee nervous. Wilbur was an investment banker who started his career at Rothschild, and in a case I had a long time ago called Revere Copper and Brass, Wilbur was dying to get involved in the case, and he got ecstatic because he got hired to be the financial advisor to the equity committee at $10,000 a month. That's a long time ago for Wilbur. Wilbur had a lot of foresight. LTV was a steel company. It had gone through one Chapter 11. That Chapter 11 had taken 6 years. And what they did is they spun off the other businesses, the aerospace and missile divisions, and they decided to focus on steel. LTV filed a Chapter 11 case in the 2000. Terrible union problems, same kind of problems that you see General Motors and Ford having, very high medical health costs. They got into negotiations with the union. The steelworkers never thought that they would close the plant. They closed the plant. Along comes Wilbur Ross, and Wilbur looks at it, and he says, I'll buy the plant. Now, it's a closed steel plant, a huge steel plant. Many millions and millions of dollars went into that plant. He bought it for practically nothing. $200-odd million, of which only $47 million was cash. And now you have to picture this in Cleveland. All these unemployed steel workers. No jobs. And Wilbur says to the union, the United Steelworkers of America, I'm willing to start up the plant, but they have to work on my terms and conditions, not on the old labor contract. And I want to screen everybody who comes in. Well, he made a deal with the union. Wilbur was very smart. He made his deal with the union, no collective bargaining agreement, no long-term arrangements, and he started LTV Steel up again. He hit the curve just right. There was, for spot steel, there was a big market, and Wilbur started up LTV, started producing spot steel, and then he turned around and he bought a specialty steel company. And then he came and he bought Bethlehem Steel. He paid about $1.5 billion for Bethlehem Steel, and he formed a company called International Steel Group, which he raised money privately, and in anticipation of going public, bought Bethlehem Steel. He went public after he bought Bethlehem Steel with ISG, and a short time thereafter, Wilbur sold his steel empire, International Steel Corp, to an Indian steel manufacturer for $4.5 billion. The estimate is that Wilbur made 17 times on his investment. That's pretty good. Then you take Mr. Lampert and ESP. There's a man who has taken 2 lemons and has made lemonade. In January of 2002, Kmart was viewed as a dinosaur. It went into Chapter 11. Mr. Lampert had actively acquired significant holdings in the bond debt. There he made a mistake. He went in after the Chapter 11 was filed, or he started just before it was filed, and he anticipated that Kmart would be able to do well in Chapter 11. It did terribly. But he was stuck. He was in there for a while. So he doubled down. And from the outside, the only thing missing when Kmart was that rigor mortis hadn't yet set in. But he sponsored a Chapter 11 plan. And he settled the bank debt at 40 cents on the dollar, took control of Kmart. They did a Chapter 11 plan. On the effective date of the plan, Kmart traded at $19.60 a share. He originated a deep cost-cutting program and began selling off real estate to Sears and Home Depot, which generated over $1 billion. However, Kmart sales continued to deteriorate, and he was able to produce earnings only through the very rigid cost control campaign. And ultimately, what you saw in Kmart is the revenue line across the sales line, and the sales were just they just kept plunging. However, by the end of November 2004, Kmart stock ranged between $110 and $120 a share, despite negative growth and a very limited capital expenditure program to renovate the remaining 1,500 stores. But for the SBC AT&T merger, Kmart would have won the title of the biggest negative growth company in the United States. At the confirmation of the Chapter 11 plan on May 6, 2003, Kmart's enterprise valuation had an implied equity value having a range of $753 million to $1.5 billion, and share price in the range of $8.74 to $17.43. What has happened in Kmart with the Sears merger is unbelievable. They now have a corporation that's being valued at $12.3 billion in the merger of Sears and Kmart. Nonetheless, the stock is listed on NASDAQ, and the company's debt is currently rated by S&P and Moody's as below investment grade. Now I come to Mr. Icahn, who has a brilliant record. And when you say activist for Carl, that's an understatement. That is a real understatement. Carl is on the heels of a tremendous victory right now. He and Mr. Ross are locking horns. Now, it's almost poetic justice, what you're doing in West Point, Stevens, because Wilbur Ross decided after the steel business he's really a character in search of a career. So he wants to be a textile king. And Warren Buffett made an offer for Burlington Industries. And the way it works in the bankruptcy court, if you get in first, you can get an edge by becoming the stalking horse bidder. And the stalking horse bidder gets this edge by being entitled to a breakup fee and reimbursement of expenses, so that anybody who comes in to bid against that stalking horse, the first bid has to include the breakup fee. Well, Wilbur was an investor in Burlington. He bought up some of the bonds. Warren Buffett came in and said he would buy it for, I don't remember the amount. And Wilbur came in to the court, and you had to get that breakup fee approved by the court. And Wilbur came in and said to the court, don't approve that breakup fee. I'm interested in making an offer for Burlington. And Warren Buffett got up and said, Judge, if you don't approve that breakup fee, I'm gone. Now, judges hear that a lot, and they don't believe anybody. So he said, I'm not approving the breakup fee. And Mr. Buffett left. And Wilbur ended up, and he did get Burlington Industries. Well, now he had Burlington, and Wilbur's very methodical. He's trying to put together an empire that has textile products, which the Chinese have not yet gotten the knack of producing. So West Point Stevens went into Chapter 11 in January of this year. January of last year, I think it was. And Wilbur became the stalking horse with Contrarian Capital, CP Capital, and Satellite Senior Income. They bought up 53% of the first lien creditors' claims. They were bank claims. And I think Wilbur felt that he had the situation pretty much in control. And along comes this activist gentleman to my left. And what'd you do, Carl? You bought 40% of the bank debt?
But it's not quite accurate. I was there, and Wilbur came along. I mean, I just want to get the record straight here. I was there. But that's right. He went and he got them all to agree to a stalking horse bid, right. And we objected to it.
And
that's true.
Wilbur was going to, about $600 million he was going to proposing to buy it for.
I don't think Wilbur's putting up very much money. That's my opinion. I think Wilbur is coming in on the heels of these bank debt guys.
Well, he offered $480 million in secured debt, plus $207.5 million in cash through a rights offering, and then Carl came along and said he might offer $800 million.
Yeah.
But what did you do, Carl? You came in and you said Wilbur shouldn't get a breakup fee. Wilbur was asking for $6 million.
I hope he's not angry at me. I mean, I really, because I'm friends with him. I mean, I haven't heard from him lately, though. I mean,
he muttered something. The bankruptcy judge disapproved the breakup fee. And as Wilbur was leaving the courtroom, he muttered something under his breath. I didn't get
Was he in the court? Did he go?
Well, when he heard you were coming.
I never went.
He thought you were going to be there.
I didn't want to upset anybody.
So now, what's happened in this arena, because of people like Carl and Wilbur, is that I would tell you 10 years ago, if you try to sell something in bankruptcy, for example, if you represent a secured creditor and you wanted to foreclose, and what you would do is you'd have a sale, nobody would show up. The fact that people like Carl and Wilbur and others are coming into the bankruptcy court has really created a marketplace. And the result of that is that people who are dealing in the distressed debt are getting much better returns than they have ever gotten before. So there is a real market out there in these companies that are in Chapter 11, and because of the distressed debt traders, the traditional kind of Chapter 11 where you could stay there for 3 or 4 years until you saw either a turnaround and the courts were very lenient with the debtor and the debtor in possession, those are pretty much gone right now. And what you're seeing is more and more sales in the bankruptcy court, and there are real assets there. I think you would agree to that, Carl.
Yeah, absolutely.
So from my perspective, looking for undervalued assets, there is a marketplace out there. Now, we've just gone through the enormous fraud cases, the Enrons and the Global Crossings in those cases, and they've just about terminated, although Enron still has a major utility for sale. The question now is, when is the next bubble going to burst? When is this bubble going to burst? And I think Carl's going to tell you that. Am I right?
I don't think it's a question of if. I think it's just when. I think, and I don't know when. Harvey, I don't know when. Yeah. If I knew when, I wouldn't be here talking to people. I'd just be waiting.
As long as I know you, Carl, I've never seen you wait.
Yeah. Yeah, we try. We try our best, Harvey. So anyway,
Go ahead.
You want me to start, or are you through? That was really interesting to hear all that money being made. It got me feeling a little bad because, listen, all these guys made all the money. I don't know why you didn't tell me about all those
people out here. Carl will cry.
I don't know why Harvey didn't tell me about all these deals.
I was afraid this was going to be a very difficult 15 minutes for Carl listening.
Yeah, I mean, I'm upset. I want to get back to work.
It turned out that this was worthwhile. So, Carl, your show.
Yeah, I don't have a lot of facts and figures like you do, and that's good that you do that. But see, that's the lawyer mentality, which is good. Harvey used to talk to me about bankruptcy, and he's right. Bankruptcy is great. But I'll just start quickly about my career and try to remember some of the little stories. So I don't know if any of you are really interested, and especially a lot of you with this Bear Stearns thing. So I seem to be on the circuit here, coming around and seeing the same people. So forgive me. I'm just trying to.
Are you trying to raise money, Carl?
Yeah. Well, why do you think I'm here? So, I like doing this actually. So it's nice of you to have me. But the real, and I'll even tell you why I'm going to try to raise the money. I'm going to get into that. That I think there's, as Harvey said, great opportunities in undervalued situations today. Even I think there's going to be some real problems ahead, and this and that. But I do think is that for activist investors is great opportunities. I really don't, think of myself too much as an activist. I'm just a guy looking to make money. I mean, that's really what it comes to, and I think what I do is sort of salutary. So it's a little like the Clint Eastwood movie Unforgiven. Maybe I'm patting myself on the back a little bit, but that was a great movie. At least I enjoyed it, and in the bar at the end, most of you probably saw, at the end, he's got this gun and he's shooting people, and he's one guy shooting all these guys in this bar. And he says, hey, when I was young, I was not good at anything much. I was never too friendly. I never had something like that, But, I was always great at one thing, killing. I was always great at killing. So I think I was always great at somehow making money. Not too good at very much else, but I was good at making money. So I got into Wall Street because my mother wanted me to be a doctor. And I was a bright student in school. I had gone to Princeton University from Far Rockaway High School. And my mother said, look, you're a Jewish boy, you're a smart kid, you have to be a doctor because there's nothing else you can do. Because my father was sort of intellectual guy, but never a success. And my mother was a school teacher herself, and she said, look, and she had the first dime she ever made, and she says, you can't make it out there in the world because the business world will kill you. Because, she came through the Depression as my father did. So they said, you have to go be a doctor. And I said, I hate medicine, I'm not interested in sick people, I don't like blood, And, in fact, I was a bit of a hypochondriac. So, that all mixes, makes you feel that you're going to do well. But I did what my mother said because I was a good boy, and she told me that if I didn't go to medical school in those days, way back, I hate to think that far back, you go in the Army and they kill you. So you'd be dead because you'd be going to one of these places. There's always a crisis, Germany, this, that, and the other. So I said, okay. So I went to medical school. I was a good student, and I got into a couple of medical schools. I went to Bellevue, actually. And I was there for a few years, and the school book stuff was okay, but I left a few times because I was a philosophy major. I never even took pre-med courses or science courses, very few, because I wasn't that interested in it. But, I like logical positivism and empiricism and very logical way of thinking. And I started thinking when I was in medical school for a couple of years, you have to be true to yourself and you have to do all this, and what am I doing here? So when anybody else wanted to go out and have dinner or something like that, medical school guys would work, I'd always be available. But I always did okay, I got it through. But then I got on the wards, and before you go to these things, sort of interesting, you sort of go on the wards and you study a disease, So you'd read about the disease, and I'd be in a little bit of a hypochondriac. I'm not too bad, but then it was bad if you're in medical school. So you read about these things, and you think you have the disease. You think, Jesus Christ, I'm sure I have pains. You wake up in the morning, Christ. So this is when I left. I had left a couple of times, but I went back. I went back because my mother told me I'd get killed if I didn't go back, so I went back. So now I go to the wards, and I go on this tuberculosis ward. Now, I read about tuberculosis, and most of you know it's very contagious, So I go on the ward, and you go into tuberculosis ward. I go in, I'm scared to hell. And, of course, with my luck, the resident looks at me. I honestly think the guy was a Nazi. I swear, I remember him, blonde-haired guy, and he looks at me, he says, Icahn, give me a differential diagnosis. So I'm looking at this little guy, and it says tuberculosis, and this guy's coughing, It was like a nightmare. I said, ha, well, you know what he got? It says up there, tuberculosis, Like, come on. I said, don't be funny, Icahn, you give me a differential. So I go, I start tapping the guy. He coughs all over me, so I figure I'm dead. I figure this is over. I'm dead. So I quit. But this time I did the right thing. This is how I got out. I didn't stop. I didn't stop to call anybody, say I quit. I went across town. I remember the walk because I was over at Bellevue, on 34th Street. I walked over and joined the Army. See? So there was no goddamn way I could get the hell out. And I joined the Army, and when the Army...
An opportunist.
What's that?
You've always been an opportunist.
There's always a shot, And in the Army, it worked out pretty well because I got into a reserve program 6 months, and I was a pretty good poker player because I learned that in college. That's what I learned, At a medical school, I really learned poker. So now I'm in the Army, and I won about $10,000, which was a lot of money then, $10,000. I leave the Army in 6 months. I got $10,000. So I get a job at Dreyfus and Company, and at Dreyfus and Company, I start investing $10,000, and I'm making money because it's 61. It's way back. But things haven't changed. Nothing under the sun changed. So I started making all this money. I mean, buying convertible bonds on this margin. And Jack Dreyfus used to tell me, because, I was sort of working under him a little bit, and he liked me a bit. And he said, you know something? You're going to lose every penny you got. I said, Jack, step aside. It's time for a new person coming because Jack had the thing, and I'm going to, this is it, Jack. And it was great, I would go and I have, girlfriends, models, and I'd buy a Galaxy convertible one day. Just write the check, beautiful white convertible because I had all this money. 62 came, cleaned me out. In about 2 days, I had nothing, including the poker winnings. There was nothing I had left except that Galaxy convertible. It broke my heart. I had to sell that Galaxy convertible so I could live, because it was only making $100 a week at drivers. So I had to do that. So I said to myself, I have to learn something. No more trading the market. There is nobody, and I say this today, there is nobody can tell you what the market's going to do. I don't care. I know some of you are not going to like to hear this, but there's nobody knows if it's going up or down. I mean, what Harvey referred to is that in the long run, there's no question that we're going to see a big drop, a big blow up, because you can't have it where all these kids are buying homes. I mean, it's ludicrous. Everybody's out there buying these homes at 2% margin. Everybody you talk to. I went to a family party and my wife's family, and I go once a year because I have to do that. And they're nice people and all that stuff. They're nice people. And I'm talking to one of the guys there who, I don't know, makes $150,000 a year, $100,000 a year in computers or whatever. And we're talking. He says, I don't really care about my job anymore. My wife makes $50, $100, but we're not going to do this pretty much, Carl, because we buy homes. So I said, what do you mean you buy homes? He says, we go in and we buy the house and then we sell it and we buy it. I said, and I never really understood how bad this is, because it's true. It's endemic. And so I said, well, you buy the house and you sell it, but what happens if there's no buyer? What happens if it goes down and there's no buyer? And he looks at me and says, I never thought about that. And literally, never thought about it. He's a smart guy. Never thought about that. It never happened to me. I said, how many you done? About 8. Got all this money. So that is going to break. There's going to be problems. But to get back to my point, I learned options, because I was always a workaholic, and I really am sort of obsessive in nature. And I really learned about everything there is to know about puts and calls. Back then, there were no computers that did this. There was no CPOE. So you had these little put and call brokers. Now, what's so little, who weren't too ethical. I mean, and they would go in and they put ads in the paper, and if you wanted to buy a call option on U.S. Steel, for instance, you'd call up one of these put and call brokers, or your broker would call the put and call broker and say, look, I want to buy 10 calls on U.S. Steel, and the broker would say, well, that's going to cost you $400 an option, something like that. And what they would do then is call up brokers they knew at all the different brokerage houses. The brokers didn't know much about options. So they would tell them, you know what, we can buy them from you for $300. But these brokers had accounts that would sell some of these calls because, it was a good return on money, because let's say U.S. Steel then was 30, so you'd make 10%. These guys would make that markup. So after understanding this business, I said, hey, look, I put out what I call the midweek option report that I just put out. And in it, I put the right prices down, what the prices should be. So in other words, U.S. Steel, if I knew that this guy was really getting $400, I put down $400. And I put down that price. I said, that's what it should sell for, $375. So there were wealthy people all across the country that sold these options that would write in for my report, because it got popular, what they should be. And I would stay to midnight down on Wall Street. I didn't know about mugging in those days or anything. I'd actually be working at midnight calling people in California. I'd stay to 1 o'clock calling people up, and then I'd take the subway home, and I built up a big following. And after, I did that for a few years, I was making, $500,000 a year, which was great in those days, just because I had 3 assistants, I had all these guys, but I worked day and night getting into all these accounts, and I got to know them a little bit. And I bought a seat on the stock exchange. I had an uncle who was a sort of wealthy guy. He loaned me $400,000. I put in what I had by that time. I saved a couple of $100,000, and it wasn't really my uncle's. It wasn't that charitable, because I had to pay him like 15% return on interest, and I had to pay him 15% of the company. So it wasn't what you call a thing. But I'm still very close to my uncle, who's about 85 now. And we're still good friends, but I bought him out of the business, which he regrets greatly. Every time I see him, he mentions that, And I said, hey, you deserted me, and we have that long talk every time we meet, which is 4 or 5 times a year, you know. I always say, I'll give you some cheese because you're like the rat that deserted the sinking ship when that back office blew up, you know.
How'd you get into takeover business?
So I'm going to explain it to you because I know you want me to get moving so we can hear your words of wisdom, right? but so I'll just tell you quickly. So I'm in this thing, and I buy a seat on the exchange with my uncle, and then I learned about arbitrage. And I know, I saw today, I hadn't seen him for a long time, John Loeb Jr., who we cleared with Loeb Roads in those days. And I learned arbitrage, which was just a perfect thing for me, where you could go buy bona fide arbitrage, not merger, where you could buy convertible bonds and short stock. And you really had no risk, because if the stock went up, you still had the bonds that could convert them. And if the stock went down, the bonds would hold and the stock would go lower. And the thing I added to it, and there were very few guys doing it then, no computers, no nothing, you could buy it on 90% margin. And we used Loeb Roads money. I thank John here for doing that. We were using the clearing firm's money because, you know, they would just loan you 90% because you had no risk. But the beauty that I could do was with options, if, you know, so I know if it goes down, I'm going to make a lot of money. If it goes up, I'm going to make a few bucks, not much. But what if it stays even or within a range? So I would set these up. So if I lost, I protect myself, because the guy who sells an option, if he loses, he gets hurt. But now I know I'm going to make a lot, so I buy some extra convertibles and sell options against them, sell call options against them, because I knew that business backwards and forwards. And we made tremendous amount of money, relatively speaking, because you made great return. So I did that for about 7, 8 years. Now, what I do today is just the same. Really think about it. It's the same thing. All I do as an activist investor is arbitrage. What I do is I buy stocks out there, and if you know what, you have to know a bit what you're doing. I mean, you have to do some analysis. But I buy stocks that are cheaper than what those underlying value of the assets are. That's all an activist should be doing. And what does the activist do? There is the reason you have this disconnect is one word: management. In one way or another, management is screwing up the company in one way or another by definition, because if you can figure out that stock is worth so much more than the underlying value, there is something there that management can do and doesn't want to do. And I don't say, and I've said this before, managements aren't bad people, generally. I mean, I've never really met, except for one that I won't go into at this point, because I'm still involved in the company. I won't tell you which company, except it's a generic truck company. Okay, and that's the only one where I will say that, you know, that there is a problem in management, a real problem in the person doing it. Okay, that's not for publication. I hope nobody report it here. But generally, these guys aren't bad guys. But they aren't generally, with a number of exceptions, and even in some cases the ones I go after. But it's what I call anti-Darwinian. And I said this a Bear Stearns, so excuse me, and then we'll go on. The problem, really, and it's a major problem, and it's going to be more and more in this country because we have to be more productive to compete. And the guys who run these companies, unfortunately, aren't the guys that really would run your family-owned company. These guys are the ones that, and as they say, they're likable guys. They're good guys, but they're the ones who, like when you were in a fraternity in college, or, you know, in my case it was Eaton Club, the guy who was the president of the fraternity, president of Eaton Club, was the guy that you liked. Good guy, always be around to have a drink with you if you were feeling down. That's the guy that's got to be the CEO of these companies today. Not the smartest, not the brightest, but not the best, but likable, sort of reliable, not a bad guy. And by definition, here's what's really happening. That guy gets into a company, he makes very few waves, doesn't have a lot of ideas, doesn't make any problem for anybody, and just moves up. And he has one skill. He's a pretty good survivor. Likable, survivor, good golf player maybe or whatever. And, you know, board likes him, not a threat to anybody, keeps moving up that ladder until the CEO notices him. And the CEO is also a survivor. All these guys are survivors. The CEO doesn't want anybody under him smarter than him, by definition, because he's the survivor, and why should he be threatened? And there's nobody that's going to hold him accountable anyway, because the boards don't care. You know, you can forget Sarbanes-Oxley. It's a little better now, but the boards really, I'm getting a little more nervous today. But the boards are the friends of these managers, of the CEO. So we are in a situation in this country where you really have a problem in management with numbers of exceptions. Now, so my point is...
Sure. Now, I heard you make that speech 25 years ago. Has anything changed in 25 years?
Yeah, maybe it got worse, if anything. I think, you know. Yeah, I really don't agree with you. I know what you're saying.
Could you ever imagine that somebody like Hank Greenberg could be ousted?
Well, yeah, I mean, come on, if you're fooling around. I mean, I'm not here to criticize Hank Greenberg, but that always was the case. Come on, you've been in scandals for the last 30 years. There's always been a scandal. There's always been a problem. But you want me to tell you something? Why? What? What was that? Hey! I'm going to say something to you. Harvey knows bankruptcy. Let's leave it at that. but you know something. Here's my point. Let me finish my. You got me train of thought here. You know. Okay. So now you got this guy who's the CEO. And he doesn't want anybody under him who's going to be a threat to him, okay? So he's going to take somebody, by definition, a little dumber than him, right? Little dumber, he's just not quite as bright. So that guy is there. That guy gets to be CEO, okay? And he's always going to take somebody under him, just a little dumber, okay? So what you have is anti-Darwinian, the survival of the unfittest, because if a guy's really good, they ain't going to keep him there. So now... at the end of the day, if you keep going in this and this and this, we're going to have morons running companies, right? Because by that, you got to do it. And that's where this country is going, because we have to compete with Asia, and we can't do it with the kind of management we have. But so what I do is very simple. I come in and I'm an activist. These guys want to survive, okay? They want to survive. So what I do is buy the stock of these companies, and I'm a threat to them. And I sort of have a brand because, with me, I can get through the first layers of this stuff. At the beginning, if somebody else buys the stock, hey, you know what? They're going to sue you. Yeah, they sue me anyway. But they're really going to do it to you. They're going to advise them with me. They say, well, Icahn's not going away. Let's deal with him. And they're going to hopefully do something to narrow that gap. That's all I want to do. To narrow the gap between the value of the stock, the disconnect between the value of the stock and the value of those assets. So there's something that should be done. Today, there's examples, and they're always a bit unique. Today, oil companies, the stocks of oil companies are way below the VPP value. You can go and you can sell forward, which is a very unique period in energy. You can sell forward 8 years. You can take that sale and monetize it. You can take that money and go buy your stock in. And if you do that, the value of your oil company is going to go way up. But companies don't want to do this. The management don't like doing it because the managements of oil companies, rightly or wrongly, and they're not even bad guys, and some of these guys are pretty good actually, but their job is, whether they lose or make doing it, discovering oil, because that's what they're trained for, that's what they like doing. And the system is such that it rewards them for discovering oil, because if they discover it, stock goes way up and they hit a home run. If they don't discover it, they get options cheaper. They just keep giving themselves options lower and lower. So there's a disconnect in the oil business. That's just one example, but that's basically what I've done over the years. So just tell you quickly one or two anecdotes. We're going into this. I learned pretty quick about the way these things work. I'll tell you about boards. I got into a company called Tappan, back one of the first ones I did. So I got on the board thinking, hey, I can make a difference here. I can say something and do something here. And Dick Tappan was an interesting company. The company had a great branded name, stock at 8, and no matter how I looked at this company and figured it out, I figured it's worth about 20. No matter how you added the assets and looked at it, but they didn't make enough money. And the guy who ran the company was a big, impressive, used to be a star fullback somewhere, I forgot where, but he scared me. Intimidating guy, big guy. So I got on the board, one seat. It was a staggered board then or some kind of thing, but I forgot. But there was one seat up, and I get on the board after a pretty tough proxy fight. So he calls me up. He says, Carl, we ought to get together. So they had the meetings at an airport out in an airport in Cleveland, and they made the meeting I think because of me. They made the meeting at 7 in the morning. So I used to have to get to Cleveland the night before, and boy, Cleveland shut down the night before at this airport, wherever the hell it was. So I'd be sitting there, looking out at the river there, or the lake or something. I never went back to Cleveland again in my life. I'd be sitting there, and they'd have this meeting. The guys would come in. First thing they do is open the checks. They get their envelope. They get the checks. They read the newspaper, have coffee, have, a thing, look at the watch. Nobody listened to anything. The guy put a few slides up, and I'm listening to them saying, holy, I really didn't know how bad things were, right? So I'm sitting there, and I didn't say anything because the first night, this guy who's 6'5" was a fullback system. He looked, Carl, we don't want trouble on this board. We really don't want to hear from you. We want to hear you be quiet. And, I said, okay, I'm not going to have this big 6'5" guy slapping me around. So I said, yeah, okay, you're right, Don. Whatever you say, Don, that makes sense to me. So I sat there listening. And 5 or 6 meetings go down. But there was no poison pills. And see, Harvey, I think that's why it's worse today. He got the poison pill today. When I did it, you could buy stock. You could keep buying stock, which was a great advantage. So I kept buying the stock and buying the stock. He kept looking at me. What the hell could he say? And I was sitting there, and he comes in, and it's 11 o'clock. Everybody's running to the airport. People are just looking at the watch. The boards are looking at their watches and all that. And he says, I'm going to introduce the board. I want to spend $80 million. It was a big number for this company on this garbage disposal units. I'll never forget it. And he shows it up there. He says, I just want the board to approve this, garbage disposal units. And I'm looking at this, and garbage disposal units were basically the mob would run garbage disposal units, not a company that's listed on the New York Stock Exchange. It was one of these things that people knew that and GE was selling it. Even GE couldn't make money on this garbage disposal unit, but he says, I can do it. I'm a great salesman. I'm going to want to get $80 million, which was like a poison pill. In my mind, he was doing this for the simple reason that he didn't want anybody buying his company, right? So now what happens is he puts it up there, and I'm looking, and I say, oh, my God, and this guy's going to prove it. And there's one little guy on the board. There's one little guy on the board who was also intimidated by him, never said very much. And he's looking, but he had stock. This was the one guy that had some stock. He had sold him some company. And he says, Don, I don't know about this. And Don looks at him and glowers at him. Are you telling me that you disagree with anything I said about this company like that? He said, no, Don, I'm not saying that. He says, but we never heard yet from Mr. Icahn in 5 weeks. I'd like to hear what Mr. Icahn says, okay? And I figure, heck, if he's going to kill me, he's going to kill me, but I'm going to lose all my money anyway, so it don't matter, right? It's like that Jack Benny thing, your money or your life, and, I'm thinking about it, so I look, and he says, okay, Icahn, do you have something to say? I say, Don, this is possibly the worst deal I've ever heard or seen in my life, And the guy, suddenly, a couple of newspapers closed. These are the guys on the board. But here's how I got them. And then I say, and I'm going to tell you, everybody on this board, that everybody that votes for this is going to be personally liable. I guarantee it. Just like that. All of a sudden, they're all looking. And Blazes glowers at me, and he says, we'll do this next time, next board meeting. Shuts the thing down and sells the company to Electrolux of Sweden for $22. So that was my learning about boards of directors. $8. So I did well, right? I did okay. All right? Okay. So that was how I learned about what boards are in America. And they're not a hell of a lot better today. Back in 1982, something like that. A long time ago. Things haven't changed. No, I think with Sarbanes-Oxley and what happened in WorldCom was a big breakthrough because now boards are more concerned, a little more concerned about what's going on, personal liability. Other than that, boards, for the most part, have no concern, don't care. They're buddies with the CEO, and that's why you have still this huge disconnect and why you can make money, because there's a huge disconnect between value of stock and value, because actually, in many cases, and you hate to say it, I hate to be this cynical, but in many cases of a company, you really do this, we do it wrongly, the CEO is motivated for a different reason than stockholders. He gets rewards differently. The CEO gets a lot of options. But what's insane is that the CEO, if he does a bad job and the stock goes down, all he does is get more options cheaper. The board just gives him more options cheaply. So he can't lose. So he goes out, he goes for the home run, he just swings for the fences, or he does whatever the hell he feels like. He's going to get rewarded with options no matter what. Now, we're in a company, as you all know and read about, Blockbuster. I mean, here's a guy who just... the company, he's done everything wrong, I think, anyway. He's made a lot of crazy investments. Maybe they'll work out, maybe they won't. But he just gave himself, the board gave him $50 million as a reward. So this is what happens with these companies that could be good in many cases. Some are okay. Some are doing it. But my point to you is that a lot of these companies feel that the company, the board and the company feels shareholders are an annoyance. You really should have nothing to do with them, and they're almost shocked when I came along. I remember once I went after a company in the 80s when Drexel was still around, and Drexel could write checks and give you money if they liked you, and I used to get money because they would give you money to do some of these deals. I had a lot of money by my own then, so I would put up my money first, but then do it. And I went for a deal back in the 80s. Something like we were paying for Phillips Petroleum after Pickens had lost it. So we went in, and I called Morgan Stanley, and I said, I want to make a bid for Phillips Petroleum. And I can't remember who it was, but one of those guys was the head of, was protecting Phillips, and he was the head guy, and he's sort of a smooth kind of guy. And I go up there, and he talks, yes, Carl, what can we do for you? And I said, well, I want to buy Phillips Petroleum. Mm-hmm. And I said, I have a check here. I have the money, $4 billion. We're going to pay, or $3 billion. We're going to pay. Mm-hmm. Yes, uh-huh. He goes, Carl, what do you know about the oil business? So I got my best remark, and I said, I'm not here for a job interview. and that's how we got that one straight now. So I did that one. And so we kept going. There are many cases like this.
Carl, how do you determine that a company is undervalued? How do you value the assets? You're not allowed into the company.
Yeah, but you do look. You really, after a number of years, and you need that. It's really not that difficult. I think everybody out here will tell you. You can look and you can see that some of these are no-brainers. Like I believe the oil companies today are no-brainers. You're going to be wrong sometimes, but I don't really go in very much into technology because that's something that I really can't understand. I can understand, what an oil well does. You can look at reserves. You can really do a present value. You really know proven reserves, proven undeveloped, proven developed. You can look at timber. You can look at cash flow. But when you start technology, now, it's interesting. In the bankruptcies, now I have EXO. But that EXO, I'll tell you, you really want to hear as much as those guys made, as much as they made, I think the EXO was the best one. And I'll tell you why. When I bought EXO, here's the deal, because what happens in bankruptcy is really interesting. Harvey's very right. There are great opportunities in it because what you have in bankruptcy is an interesting dynamic. You get banks that get these. Banks sort of inherit them. And then the banks give them to a workout group at the banks. And that workout group doesn't really understand the company. They just sort of want to be out. But, or not be out, at least get some paper and get something for it. And they're not really into the company or anything like that, which is Harvey's right on in saying it. So in EXO, what happened was, that's why it pays to have a lot of cash around. Because in EXO, we went in, and long story short, the banks were sitting there, and they sit, and they wait, and they watch. But the banks don't want to have to show a real big loss on their books. So the dynamic is, and I think you'll agree, the debtor in possession, the law is crazy in this. They let a debtor in possession stay there forever and ever. Now, the law just changed, so it's a year and a half, right, where you can only be. Yeah. But before this, the debtor in possession is protected by firms like you used to work for when you protected the debtor, as I remember.
I like debtors.
Yeah, you liked them. They paid you for the kids in school and the homes and everything. So, am I right in saying, do you guys protect the debtor? You did. You used to. Okay. Now, the debtor is there.
Even when you were a debtor.
Well, touche, that's true. Although, I don't remember you protected me. I don't think you protected me too much, but it doesn't really matter. I'm saying a point here, and I think you agree with this dynamic. That the debtors there, they're protected way too much by attorneys or whatever. And they keep coming up different plans. And one of the things they'll do, and they're not bad people, that's the law. They'll scare the hell out of these banks. They'll go in and they'll tell these banks, hey, we are going to have to, we're burning at Exxon, we're burning all this money, we're burning millions of dollars, we need more money, we do it. And they scare them because what the debtor really wants to do, in a lot of cases, is keep the company by getting a plan done where the banks will say, you know what, okay, there's nobody will give us any money because the debtor goes around, and maybe not on purpose. I'm not even going to say they do it, I'm not saying they're lying, I'm not saying they cheat, but they're going to go out and they really believe it, especially a technology company that's hard to understand, and they'll tell you, hey, you know what, these assets, what can we do? And in fact, they're sort of right. I mean, you take telecommunications, the debtors are sort of right. This guy that ran Exxon was a nice guy, wasn't a bad guy. He was going to be called, something? My job was to build revenue. I never saw, nobody told me the market's going to shut down and nobody's going to give. The bubble burst. The telecommunication was insane. They kept putting money into the ground, and at the end of the day, there's just too much fiber. The CLEC, like an EXO, was better. The CLECs are better because at least there, where you're in every city and you have these networks, you at least have a market. The long lines are, just crazy. There's just too much fiber around and there's just too much capacity. But in any event, so you take EXO. So the dynamic in a bankruptcy, and here's where you really, I think, can make the money. The dynamic in a bankruptcy with many arcane changes, and bankruptcy is extremely arcane, and Harvey's a master at it, and I know a lot about it. I've learned a lot about it. I think for a guy that's not a lawyer, I probably know as much as almost anyone in that, and I probably know more than most lawyers, except for guys like Harvey who are bankruptcy lawyers, because most lawyers I don't think really understand it. I mean, and it's a very arcane art. It really is with so many things. I mean, I'll get into it in a second, but so this EXO. But here's the dynamic that you got to understand. So a finance guy like me with capital can take advantage of the situation, because what happens is that they'll come along, the debtor in possession in a lot of cases, and scaring the hell out of the banks. So the banks will say, okay, we'll give you a deal. We'll turn some of our debt into equity. We'll take pay in kind. We'll do this. We'll do that. You go run the company because we can't handle it anymore. And they do a plan of reorganization. But a guy like me fights those. I come along and I'm their worst nightmare, because when I'm there, I'll say, hey, I'm not interested in that. I'll take the company over. I'll take the risk, because they're not scaring me. So I'll go in and I'll listen to it and I'll say, hey, thank you very much for being here. We love you. You did a great job. Goodbye. Here's takes your check or whatever the hell the deal is. And some of these deals are boondoggle deals because they're getting paid for it. I used to love to say they get stay bonuses. And I used to say to the judge, why do I have to give him a stay bonus? I don't want him to stay. So, so that's what I used to do with the judge. And they go, oh, well, that's good, And so this is what used to happen. So at any event, they come in and they go and they, so EXO is a good example. And believe me, I really like the head of EXO. I mean, it's not that this guy was wrong. I mean, he said, hey, I got these ideas. We got to do this. We got to do that. You better give me, I got to get this out of bankruptcy. And he had the banks thinking, yeah, okay, we're going to take paper, we're going to do this, we're going to do that. Now, along comes WorldCom, blows up. The banks call me up, because I had, a debt, and I was fighting the deal where they were just going to take paper, but, we were at odds, but still, it was just going along, and I had some of this debt cheaply. And the banks call me, and things blowing up, say, look, Icahn, you want to buy our debt, we'll sell you the debt. So I said, great, so I'll give you 50 cents on the dollar. But the beauty of this deal was you had $9 billion in assets. I bought this company for cash, $500 million, basically. It took a lot of work because I had to, we had to do kind of cram downs on the other holders. But basically, here's the beauty of this one. Now, okay, look, that's part of the game. It's not me. I don't make the laws. But
I have to tell you a story.
Can I just finish my little story? I want to finish. I'm going to Okay. I got to listen to this one.
Carl made a run at Texaco when Texaco was.
Oh yeah, that was good. Yeah. He was a lawyer for the company, right?
I represented Texaco, and we were at the confirmation hearing, and Carl was opposing the confirmation. He wanted to propose his own plan, and we were opposed to that. And Carl takes the stand, and his lawyer gets up, and his lawyer says, "Mr. Icahn wants to testify in narrative form."
I don't remember this, though. I said it, so I can try.
Your Honor, that's not the way it's done. And when you're on trial, you ask a question, you get an answer, and I have an opportunity to object to the question and so on. And the judge says, "You're absolutely right, Mr. Miller. You will not testify in that narrative form." So his lawyer asked him a question. He then spoke for 45 minutes.
Yeah, but I got that Texaco out of bankruptcy, if you remember. Can you give me credit? I made that deal. Come on, I got that deal done with Jamil. He was representing this guy Kinnear at Texaco, which got themselves in a little mess with the lawyers. Got themselves in a mess, not you, but because you were the lawyers. These guys did this brilliant deal at Texaco where they went and they bought Getty Oil, and they sort of forgot the fact that Getty was already sold to Pennzoil, you know. So they let that slip their minds. Although the claim they were really right. I mean, it was the dumbest case that ever existed. They let this get into a Texas court. A guy named Joe Jamil has this thing in a Texas court because the lawyers for Texaco let it get there. You know, and that was, we won't say, no names, okay, you don't want names, okay, but they let it get. So, I got to say, Harvey's representing, so Texaco, so the Texas court comes in, and this guy Joe Jamil, who's a great lawyer, and it helped that a few of his cousins were on the jury, but, you know, that didn't really matter too much, you know, that was just a little thing, because it was town, you know, so that helped a little bit, but this is not going to be the newspaper or anything, you know, but Jamil was a good guy, crazy guy from Texas, so he goes, and he gets him in this court in Texas. If it had been in Delaware, which it should have been, there was no case. I mean, Pennzoil never had even a written contract with Getty. So, but Jamil, and they weren't even going to sue. So Jamil comes in, and Jamil made himself a check for $600 million from himself because they got $2 billion or something for this thing. Was it?
$11 billion.
No, not
oh,
no.
They
settled for three. I was the guy who did the settlement. Here's what happened. They come in, and this company is worth a lot more. You know.
But how did you get your interest in Texaco? You were an opportunistic.
Oh yeah.
Robert Holmes Accord was in trouble.
I was going to tell him. I'll tell him the story. I'll tell you. You want to hear this? I'll tell you fast. This guy Holmes Accord is the richest guy in Australia, and he comes to see me. I didn't even know who he is, but a real nice guy, the richest guy in Australia, and he says to me, "Can I come see you? I'd like to see you." Now I don't know who he is. I heard of Holmes Accord, rich guy in Australia. This is mid '80s, and he comes up to my office. Very quiet guy. And he says, "You know, Carl, you should look at Texaco because I do not become an activist. I have too many friends, but that management is not too sterile." So, you know, I said, "Good, yeah." So then he says, "You really should look at the company." And then he says, so I looked at the company. He says, "I have a big position." Then we started talking. And he says, "I have a lot of cash on hand." He says, "If you ever," and he was a real good guy. I like the guy. And he says, "If you need something, whatever." I said, "How much you have?" He says, "I have about $10 billion. I said, "That's pretty." No, but you got to hear this. He says, I said, "Do you actually have $10 billion cash?" He said, "Well, but not really. I have credits with the banks that I paid for in New York." I'm going to tell you, Robert, I said, "So Robert," I said, "when you need the money, they won't give it to you. I'm just telling you, you should get the money, get it on your table, get it into the accounts," which I always do. I've learned this. Get the money in your own account. Pay the arbitrage difference of the 2% or the 3%. Pay that. That's the smartest money you'll ever do. But don't have credits. When you need it, they won't give it to you. So anyway, Holmes was a very proper kind of guy, and I'm going to have to curse here a little bit, but I hope you don't mind. But he says to me, "Carl, you're wrong. They're my friends," and whatever. So I look at stock is 52, 53, and he's right. It's worth more, but you got the manager, it wasn't worth a fight. I bought a little stock. And 87 comes along, and the market breaks, and this all happens, where this guy, Jamil, maybe it was 88, but Jamil gets him into court.
86.
It was 86. It was before the market break, I guess. So he gets him into this court in Texas, and the lawyers, Kinnear was a nice guy who ran Texaco, so if it were me, I would have sued the law firms. I would have gone after those law firms because they really screwed it up. But in any event, they get him into this court, and they never should be the court. They bring in these lawyers from New York, and this jury is sitting there, and Jamil's there, so now they go into what are the damages, So Jamil says, well, there should be punitive damage. That's why he talk. There should be punitives. So the judge doesn't care, they're looking. Well, all the lawyer had to do is get up from New York and say, how could there be punitives? These guys didn't do anything. And even if they did, the whole deal that they paid for this whole company of Getty was only $3 billion. So how much could the damages be to Pennzoil for not getting this Getty oil for $3 billion? How much could it be? It wasn't that much of a bargain. So the guy from the law firm that Harvey don't want me to mention gets up, and he says, Judge, we will not even dignify a discussion of damages. So the judge, okay, Mr. Jamil, what do you think? I'll tell you damages. Damage my client, $12 billion. The jury goes down and says, $12 billion. So now they got $12 billion. They got a $12 billion judgment, okay? And they go into judgment, and the Texas Appeal Court won't hear it. They wouldn't hear it. So they go to Harvey, and they go bankrupt, because how the hell could they pay $12 billion? Texaco didn't have $12 billion. So the stock goes from 50 down to 29. And of all things, I'm on a plane somewhere going to Martha's Vineyard. My wife didn't like the Hamptons or something, so she wanted me to buy a house in Martha's Vineyard, which I never bought. But I was on this little plane, and I remember seeing the Daily News on a little thing saying Holmes of Court in trouble. So I call Holmes of Court up. I tell my secretary, call Holmes of Court. I haven't seen the guy. I heard from him 2 years. Maybe I talked to him once before, but, in between. So I call him up, and I get home, and he calls me at midnight because he's in Australia. He flies around at 7:27, used to, and he never knew where he was, but he calls me up, and he's very quiet. He goes, Carl, you called? I said, well, I did a little research. Sir Robert, not my business, but heard you got a few little problems. And see, I think the market was breaking. I think it was 87. So he says, that's quite correct. I said, look, again, I heard Sir James Goldsmith's trying to buy your block of Texaco, and I'm going to offer you, I'll offer you $29 a share, which is selling at. I said, I'm not going to pay any more. And you know what? You got permission. Tell Goldsmith Icahn's bidding you 29, and if he wants to pay more, you owe me dinner. He says, very far. Very far. He says, I'm going to sell it to you now on the phone. Call your lawyers. I said, well, it's midnight. He says, no, call them. Let's get it done before the opening. You and I have a deal. And I say, okay, so thank you. And we get the deal done. And then he says, and by the way, Carl, you were right about those fucking banks. That's just what he said. I remember that. You were right. That's just how he said it. I said, thank you, Robert. He says, yes, Carl. This is the most brilliant deal you'll ever do, which turned out right. Because now Jamil comes to see me. They got it in bankruptcy court. And Jamil and Kinnear aren't talking to each other. Jamil, for some reason, is mad at Texaco. And he comes in with Litke, the head of Pennzoil, into my office at 10 in the morning. Jamil and Litke. And Litke weighed about 400 pounds, 300 pounds. And the two of them walk in my office, and they're yelling how, Jamil, you can help me get a settlement. You can do it. Because Kinnear is the stupidest man in the world. That's the head of the stupidest man in the world. I said, well, all these CEOs aren't too bright. No, you don't understand, Tom. He is dumb. The guy. And he's yelling. I said, okay, Joe, relax. So I said, you relax. And then Hugh's there. And I said, well, how much you think you're going to get? He says, we want at least $10 billion. So I said, $10 billion? You're not going to get $10 billion. So Litke gets up, and he said, I told you we can't talk to this guy. He's no better than the others, Joe. And so Litke walks out. And now Jamil's walking out. Then he walks around. Now, he says, you know something, I think I can talk to you. He goes, I think I can talk to you. Let's go have a drink. So this guy, Jamil, really likes to drink, 10 in the morning. I said, where am I going to go have a drink, Joe? We'll find a place. And he goes, and so we went out, and that's how we made the deal. So he goes, and we sit down, and he sits with me at Parker Meridian, So nobody there, because I used to have lunch there. They turned the table. It was like in a Humphrey Bogart movie. They give you a table. We're sitting alone there, and he's drinking these drinks, and I go, and he looks at me, I look at him, and we're getting along. I like the guy. Funny as hell, we're talking about it. Then I look at him, and this is how the deal's made. He goes, I say, Joe, you're not getting $10 billion, but you ought to make a deal. And he looks at me, and he just, what can I get? Like that. Just like, what can I get? I know you talk to him. What can you get? I say, you can get $3 billion. That's it. You got a deal. And he puts his hand out. That's how the deal went. You got a deal. He says, I'll deliver the fat man, and you deliver all those idiots up in Westchester. And that's how the deal was done, right? What's that? Yeah, I get it. Hey, man, that was that one. So those are the deals I'm in. You got to look for these opportunities. And what I was saying to you is,
Carl, you should give him the punchline and tell him how much you made on the deal.
I made.
That's the punchline.
It's public. I made $600 million. He made $600. I think it was only fair. I should make what Jamil made. What the hell, right? I told him that. I said, I expect you to give to charities. What you talking about? Yeah. So I tell you that the opportunities. Who did? I did. Jamil did? What building? Down in Texas?
In Texas, in the university.
I won't tell you because a mixed audience, some of the stuff he said. It was so funny at that restaurant. But I'm not going to get into that. But at the end of the day, we got that deal done, and we kept moving along. The situation is such as today that, and the reason I'm doing this fund is I think that when you do these takeovers, you do these activist plays, not takeovers, it's difficult. It's as difficult, it's more in certain ways because you got the poison pill, whatever. And the 1-2 punch you have to deliver is that you have to have credibility. And to have credibility, you have to have money. And it's as simple as that. We have an opportunity. With me, they know that I'm coming. I'm not bluffing. But to really get these guys, they have to know you have the money. You're going to run a proxy fight, but you have to have the capital to make an any and all tender. I mean, the way Oracle did it with PeopleSoft is a very simple primer for what has to be done with these big companies. You have to have that money. And today, I think the great opportunities, really great, lie in the very big ones, the huge ones, because they feel they're completely above reproach and they feel no accountability. And so I enjoy doing this. So, the fund I'm doing is to grow it and grow it if I can. If I can't, we're doing quite well. But if I can't grow it, we have a very good record for the very short period we're in. But if I can't really grow it, I probably won't keep it. But if I can grow it, the fact that you have that capital will give you, I think, greater credibility and greater opportunity. And I think those opportunities abound. So I think to sum it up, the ability to make money on a risk-reward basis, there is nothing as good as being an activist. There's nothing close to it because by definition, you're gonna fulfill your own prophecy. So by definition, you find, it's like you do the first step, you do the analysis. Many of us can do that and see that there's something that's great, undervalued. Many people can do that. But then you got to hope if you do that something's going to happen. So the next step, obviously, is to make it happen. So it's quite as simplistic as that. So that's my
wonderful, Carl.
Thank you.
Thank you very much. Thank you very much, Harvey. So now let's see what intellectual capital we have in the audience in terms of good questions. One in the back.
Do you see any type of conflict between short-term activist investors who are thinking only about short-term capital gains or return of capital versus management who may have a long-term strategic vision doesn't necessarily jive with what a couple of shareholders can get together and force a buyback or force some kind of special dividend?
Well, I mean, that's sort of the, this is sort of the what I call tripe that these managements put out, that they got long-term vision, I mean, I'd like you to show me a manager with long-term vision. I have not met any, but there are some good guys, no question. But if you look at most of these deals that I'm in anyway, the reason you have this major disconnect, for the most part, is that not only don't they have vision, but they've been messing up the companies. And I defy you to show me one that I've been in that for the management haven't, one, really not done what should be done, two, have not gone into areas they shouldn't be, three, do not get huge bonuses for themselves. And so I really don't think that in any way we're doing anything but what is good. And I really mean this. I mean, I'm not telling you I don't do it to make money because I enjoy that. But what I do, I think, is very salutary, to go and make these guys accountable. And I'm going to tell you something, that and I think it's more not even if anymore, but when, there are going to be major problems because we can't compete with Asia. And one of the reasons, is, okay, we have high costs, but another reason is that our managers are not the right ones to run these companies. The people that, if you look, I mean, it proves itself out. If you look at family-owned companies, you look at any statistics, family-owned companies do much, much better than publicly-owned companies. And there's nothing really being done about it because you have this internecine relationship between the guys that own these things. Actually, hedge funds are really a good development for governance, because before, and this is the one area I really think it's gotten better for these takeovers, because before you'd have these big mutual funds, and they really didn't care. The mutual funds owns, if you're in the tobacco business. I was in Reynolds Tobacco for 4 years. Mutual funds really didn't care too much. You're in all these tobacco stocks. I mean, obviously we should break off Nabisco, obviously, right? I mean, Goldstein used to call me a rite of spring, because every year I'd come, I have a proxy fight with him, I attack him, I say spin off Nabisco, and every year he'd jawbone it up, go around, tell him, hey, I'm going to do this, I'm going to get the government to change the law, I'm going to do this, stock would go up, I'd sell it. The next year it'd come down again, I'd go back, go hit him again, he'd go, yeah, the rite of spring is back, and we go back into a proxy fight. Okay. After 4 years, I mean, it's public, I made $1 billion on the thing, because eventually he did what you had to do, get rid of Nabisco. But you're not going to tell me he had vision, not that he's a bad guy. In fact, I like the guy. But the issue is that to get to my point, that you have this internecine thing where the funds, the big funds, would not really vote for somebody having this proxy fight kind of thing. But the funds today, the hedge funds, are much more result-oriented. I mean, you guys who run these hedge funds, I mean, you got people there, you're looking for your return, you're getting this big, huge, return on the profit. So if there's a way to make money, you guys are going to vote for it, which is a big plus for the takeover stuff. And there's another little-known ruling that came out that makes transparency, that makes these big funds have transparency when they vote, so they let ISS do it. Because it used to be these very funds would get their pension fund money from these very companies. You can't ask a guy to bite the hand that feeds you. And these funds get huge money from these managers from these big companies, so they're not going to go after them. But now they hide behind the IIS, which is good, ISS. And so that's the thing. But I really do not believe in long-term, long-term vision of these companies. Because, if a manager really has a good idea and really wants to do it as CEO, he can explain away the short-term results he has by going and showing the large shareholders, this is what I'm doing. But that's not what goes on.
Harvey?
Is 4 years a long holding period for you?
What, for Reynolds? I didn't hold it 4 years because I'd sell it. I bought it and sold it
But
each
generally,
time.
what's your investment horizon?
Nah, much shorter. Much shorter. I mean, for me, if I can't take over the company, you see, taking over the company, ironically, would be great. You really make your most money taking them over. I mean, look, we have problems too. Everybody have problems. But if you can take it over, it's good. In the bankruptcy, you can take them over. In a bankruptcy, you have an opportunity to really do it. In these deals where you have public stocks, it's more of a problem to take it over, because in a public arena, to take it over, I'm buying wholesale, really. I'm buying these stocks cheaply. They're going to run to a private equity firm or to a synergistic buyer before they'll ever let me get it, assuming I can ever get that far.
Winning a proxy fight much better today than...
Yeah, I'm saying only because of the dynamics with the hedge fund. But you have staggered boards, so you're not really going to take the company over. When you're doing a staggered board, in a certain ironic way, the staggered board is almost good for me because, while a lot of shareholders may not vote to let you take over the company because that's a big step, they'll let you get 2 guys on the board or 3 guys on the board. And that's a bad step for the management. Don't want us on the board. So, so the management will do something to keep us out, which is, what should happen.
All right, we have another question at the back.
I'm interested in 2 thoughts. Your thoughts first on Morgan Stanley, what happens there, how it plays out, and the other macro is private equity. A lot of big firms have raised a lot of money in the last 18 months. What are your thoughts on that?
Well, who's that for? For me? Well, Morgan Stanley is not a company. As I say, I like assets. Morgan Stanley, is selling overbook, and it's really related intellectual capital. And so I'm not involved in Morgan Stanley at all, and I really don't have much of an opinion on what of what's really happening there. I know a lot of the people there, and I wouldn't want to venture one anyway. But with the private equity, what is the question exactly about the private equity?
Funds have raised a lot of capital in the last 18 months, and some speculate they're overpaying for investments, and what your thoughts on that landscape?
You mean for their investment, you're saying?
Chasing a few deals, overpaying potentially, and is that a bubble, or is that still a...
I think that in itself is not as bad, actually, as the leverage in some of these hedge funds that the leverage that these hedge funds are using today, where it's amazing where the hedge funds have really thrown out this whole concept of the Federal Reserve rules, where you're supposed to buy a 50% margin. Today, there's no margin. In fact, it's almost funny. I mean, you go short something and then use that money to go long something. So, obviously, those are the seeds of a bubble. And if this real estate thing flows, I can't tell you how a bubble is going to happen, but whenever you have that kind of leverage, I think it's extremely risky. The private equity guys at least own the companies. So, I think...
But you'd agree, Carl, that there's a lot of money chasing deals, and the consequence of that is that the deals are getting skinnier and skinnier.
Absolutely. And here's the real problem where the bubble could burst. So if you look at the hedge fund community, with the exceptions, of course, that if you're leveraged, the idea is, well, I'm long and I'm short. But it seems to me that a lot of the same stocks are being bought by the same guys. I mean, you're all a bunch of bright guys, and the hedge fund guys are bright guys, so they go and they buy pretty much, with exceptions, the same things, because those are the ones they see. So they're smart guys, so they buy long those, they short the obvious ones. But one day, if something happens to blow this bubble, the same long stock is going to be for sale by the very brokers. It's a little bit like Holmes Accord. You guys will be saying those fucking brokers, because they're going to be selling you out. Now, I'm not saying you, who's ever here, but I'm saying in general, you have to be real careful. You have to be very careful about that. I mean, it's a very questionable. Yeah, it's a dangerous situation, I think.
Mr. Icahn, we know what your mother wanted, but what do you want your legacy to be?
I really...
Young for that.
What's that?
You're a bit young for that question.
Yeah, I'm awfully young. I don't know if you can ask me that. But, no, I really feel strongly about the fact that that this economy, you know, I like doing what I do. I like the scorecard. I like playing the game. But I really feel if I can do something, and I try to do it, and I think I have to some extent, showing how we have to make our companies accountable. We have to make our managements, there should be laws changed. There should be rules changed. We have to make them accountable. You know, what I do sort of proves the point that, you know, look, I'm no better than you guys or any of you. I really don't think I am. I mean, after 30 years, you know, 40, you sort of get instincts. You know when something's cheap. You know when it's not cheap. But, you know, most of you guys looking at balance sheets, studying it, can pick out what's cheap. You know, you don't have to be a great genius, and I'm not, you know, at picking that out. I'm a good strategist. You know, I'm a good chess player. But what I would like to see happen, and that's why I really like doing this, is making these companies accountable and me having something to do with it. And my record, the record that I have, you know, sort of proves. Because I'm telling you, I'm not that great at picking stocks, so it's not bad. I mean, I don't think anybody's that great. So I'm saying, but look at our returns. I mean, my returns over the years are, you know, stupendous, relatively speaking. Why? Because I go in and make something happen. And that proves that there's something wrong in the system. And I'd like to see rules change, laws changed, so that we make these managers accountable. I think it's reprehensible that these guys, you know, I mean, they're not bad people, so I don't want you to get the wrong idea. I sort of like most of them. But it's ridiculous. It's reprehensible that they're getting the kind of pay they get, the kind of returns they get. But worse than that, they really are the wrong guys to run the companies for the most part. That's really the situation. I mean, and you know something? I might even take that back. I mean, well, the joking aside, they might be the right guys if they had to be accountable to somebody. But the boards, don't fool yourself. Don't, Sarbanes-Oxley, the boards now are a little more concerned about getting personal liability. So, you know, when something bad happens, like with Greenberg or something like that, they're going to come in and say, okay, you got to go. But basically, for the most part, you know, when they can give a guy like the Santiago $50 million doing a bad job. So you tell me, what does that mean? It's absurd. That's a simple. So I'd like to see that change, and maybe I can make that happen.
Well, thank you very much, gentlemen. We certainly hope that money flows to Carl Icahn and he can have his salutary effect on more companies, perhaps this year the United States and next year the world. And Harvey, we hope that many companies come to you for good advice from Greenhill and Company. Thank you all for coming. And now back to Steve McMenamin, the brains behind the whole Greenwich Roundtable.
Thank you.
Thank you very much, everyone. Ladies and gentlemen, please join me in welcoming and giving our gratitude to the people who made this evening possible tonight. First of all, Richard Eldon is one of the more sage investors in our business, and Richard has provided us with refreshments with his compliments this evening, in addition to introducing us to Carl Icahn. Bob Greenhill is a rising venture capitalist. He's introduced us to Harvey Miller. Ryan Dartnell is one of the stars of our programming committee, and he's orchestrated this evening. And most importantly, I would like to, and I want you to thank Douglas Makepeace. Douglas has absolutely no commercial interest in this session whatsoever, but Douglas has generously underwritten this evening for us. So please, let's give him a big hand tonight. And I got a tap on the shoulder. Someone said to me, this is quite possibly the best Greenwich Roundtable we've ever had. I know a lot of you may agree with that, but Carl, Harvey, thank you. Wonderful evening, and please join us again, perhaps in the autumn with Eddie Lampert to explain what he's doing. Thank you.